You're probably thinking about buying a home in Middletown in Delaware in 2026, and you're probably wondering one thing. Are home prices still rising, or are they leveling off? Or is there finally a drop coming? In this video, I'm going to break down exactly where Middletown home prices stand right now using real numbers, what's driven the market over the last few years, and what buyers need to watch heading into 2026 so you can make smart, confident decisions. If you don't know me, I'm Christian with Swan Realty. I work with buyers and sellers across Middletown and Delaware every day, and everything I'm sharing is based on what we're actually seeing on the ground. Let's get started. So the big question that buyers are asking is, are prices still rising? Are they leveling off, or is a drop finally coming? Why you can trust this info? I work with Middletown buyers and sellers daily. I'm born and raised in Delaware. It's based on real local data, on the ground activity, and it's not headlines or guesses. The first thing we're going to look at is the median sold price. So the median sold price for last year was around $476,000. That was around a 4.2% year over year growth for last year. Property value tells a little bit of a bigger story. The median estimated property value was $544,000. That showed a 4.4% year over year annual increase. The key insight for this is that prices did not stall or collapse. The market normalized after the pandemic surge, and it was a healthy, sustainable growth pattern, and there were equity gains for homeowners. What normalized really means here is that in 2020 to 2022, there was a dramatic run up in prices. In 2023 to 2024, market began cooling. And then in late 2025, there was a slower, healthier growth. And then in 2026, the outlook is that there's going to be stable appreciation across the year. Why prices rose? Well, there was a population influx from the surrounding states like New York, New Jersey, Maryland. People were really relocating into Middletown. And then also other places in Delaware, people were coming into Middletown. There was a lifestyle appeal for places like Middletown. And then there was a lot of people coming to Middletown for the school district. A lot of people wanted to send their kids to the schools, and so that's why a lot of people were moving into the Middletown area. Another reason why prices rose were inventory constraints. There was a limited resale inventory, so there weren't enough existing homes on the market to resell. So that put a lot of pressure on the supply, and so scarcity kept upward pressure on prices. There was a lot of also buyer competition. So fewer choices meant multiple offers. And so when you get multiple offers on a house, that typically drives up the price of the house. Another reason prices rose are rate behavior impacts. So sellers typically stayed put. At that time, there's a term called the golden handcuffs, meaning when a seller had a good low interest rate, they did not want to move. So it was kind of like either give me a good, really high price for my house or I'm not moving. And so that was kind of the situation. And so activity slowed, but it didn't completely disappear. But buyers typically prioritized monthly costs over priced. But again, sellers typically were locked into low rates, typically back when there was a big refinancing boom. And so, that situation happened. And so sellers just didn't want to move unless they were getting a really good deal for it. This year, the forecast and the big picture for 2026 is that the market is warming and not booming. So there's going to be steady improvement. There should be more activity. So sales volume is predicted to increase by over 10% this year, which is a huge increase. There's supposed to be modest price growth. So it's going to be measured. And then confidence is supposed to return in general to the buyer market without overheating concerns. And the confidence is supposed to return because of the interest rate decrease recently seen in the public. The national signals to watch are going to be the metrics of the home sales that are happening, and then also the price growth in the homes that you're going to see as well. What this means for Middletown specifically is that buyers are going to gain lots of leverage if rates stabilize. So negotiating power for you guys will improve if you are a buyer. It's also going to mean that more listings are going to emerge on the market. So inventory is going to increase, which means that more choices are going to be out there for buyers if they are looking for a home. And typically, with more choices, means lower prices just because of the laws of supply and demand. Overpricing will be exposed for sellers on the market that are priced too high. Unrealistic sellers will face market reality much faster with more listings on the market. The other thing is that homes needing updates will also come on the market, and fixer up opportunities will become more apparent. The four market levers that buyers are really going to want to watch for to pay attention to if they're going to want to make a move on the market are mortgage rates, inventory levels, buyer competition, and new construction incentives. Specifically with new construction incentives is builders create opportunities for sellers, specifically sellers that have been in their homes for a long time with low interest rates, because seller new constructions offer incentives like rate buy downs. So sellers that have low interest rates can now move into new construction with now the same low interest rates if the new construction builders offer incentives like rate buy downs. Another lever that you're going to want to watch for, like we just talked about, is mortgage rates. In 2026, right now we're hovering around 6%. I think we're going to be getting into the fives territory here soon, if not already. Why this matters is small rate drops can impact payments a lot, and buyer activity reacts very quickly to rates. So even small quarter point shifts can impact affordability and buyer activity very quickly. The other two is in the other lever that we're talked about is inventory dynamics. So inventory is up year over year by 15%, but it is still below pre-COVID norms. So we're still below normal inventory levels, but it is up year over year. So we're moving in the right direction, but it's still not back to normal. Again, you're going to want to watch buyer competition. In 2021 to 2022, there was a frenzy. There was bidding wars. Buyers were waiving contingencies to get the house they want. In 2023 to 2024, it cooled. Competition was decreasing, but it persists. Now in 2025, going into 2026, things are becoming much more selective. The best homes are moving fast, and others are now going to sit. Today, I'd be a little bit more strategic. Price sensitivity is going to matter a little bit more. And then the fourth lever, like we just talked about, is new construction. Again, it acts as kind of like a pressure valve. I just said, builder incentives, rate buy downs, and closing costs help. The move-in ready appeal is another factor. There's no repairs. There's warranties included. You don't need to do anything. There are no repair addendums, no repair negotiations, no back and forth. It's all ready to go. It's a strong alternative, so it's a competitive option for buyers looking for another option besides resale homes already on the market. How buyers are going to win in Middletown and Delaware, and then across the nation. Otherwise, in 2026, strategy over speed. A thoughtful approach is going to beat rushing. Payment planning is going to be critical to long-term success. I see too many people rush into buying homes in situations and then scramble at the last minute to get cash together or funds together or figure out their budgeting. So figure that out in the beginning before going down that road, and it will make things much smoother and easier. The other thing is that negotiation is going to return. Lately, negotiation has been a little bit more rough, but now I think going into 2026, negotiation is going to become a bigger factor and it's going to return. And so it's going to become much more normal to go negotiate on price and go back and forth. Now that's going to go back to a buyer's market or more towards a buyer's market than a seller's market. Another tip for buyers is shop the payment. So compare lenders, not just rates. Examine points and buy downs. Match loan scenarios exactly. So the same price, the same down payment, and the same terms. Don't change prices. Don't change down payments. Don't change terms when you're going from lender to lender. Use the same scenario. Review also loan estimates. Get multiple official quotes to compare. Tip number 2, you can target stale listings. So listings that have been on the market for 30 days or more. You can leverage that opportunity to negotiate down the purchase price. You can request closing cost credits to go towards closing. You can maybe request for repair credits to cover any repair addendum requests that you are requesting them that the seller do before you go into the house, that things they might need to fix that you saw or requested, like I said, on the repair addendum after you get the inspection done. You can also combine any concessions strategically, any of the above that we just talked about. Tip number 3, use any of the smart negotiation budgets like we just talked about. Closing cost assistance, rate buy down credits, repair credits, flexible terms. Flexible terms is a big thing. I don't see enough buyers being flexible on things like contingencies, closing dates, anything like that. If you're working with a seller and let's say they have another home that they need to buy and move into as well, be flexible. That goes a long way with sellers, especially when it comes, like I said, to closing dates. Because if they have another home that they also need to buy and move into, like I said, be flexible. That could be the difference besides winning the house and losing it. Because it's not always about price for the seller. Sometimes it's about convenience. Tip number 4, be picky, then be fast. So walk from bad value and don't settle on overpriced homes. Know your criteria. So be clear on what you must have and be clear on what it's nice to have. So be clear on what you can walk away from and be clear on what you have to have. Move decisively, meaning when the right home appears, move fast. But when the home that you could let go, you can let go, then don't move fast. Let it go. And number 4, quality still matters. So good homes, if you know it's a good home, it's going to get attention fast and it's going to move quickly. Tip 5, strengthen your pre-approval. So fully underwritten offers stand out. So complete income and asset verification up front. Certainty can beat higher prices in tight races. So especially important to risk adverse sellers. So when a seller thinks that something is risky in an offer, they typically won't accept it. So when you remove financing contingency concerns, that makes it less risky for the seller and less risky for the deal to fall apart and more chances for it to go to settlement and be a successful closing for the seller. Here's a buyer readiness checklist, and this is the last part of the presentation, and this is what I'll leave you with. So 1, get your pre-approval ready. 2, get cash to close verified. 3, get an inspection strategy planned. 4, get your offer terms mapped out, like what contingencies you must have, what your timeline is, what earnest money you've decided to put down up front, the deposit, not the down payment, the deposit. And then 5, get your backup plan in place. So any alternative neighborhoods, alternative price ranges, maybe if you don't meet your timeline up front, maybe you have an alternative timeline, things like that. If you liked the video and it was informative, please, like, subscribe, and follow for more.